The stock market is a device for transferring money from the impatient to the patient. Warren Buffett. Have you ever wondered why some people seem to accumulate wealth over time, while others are constantly trying to make up for losses? The answer may lie in a simple yet powerful virtue: patience. In the world of investments, patience is not just a desirable quality, but a fundamental strategy. And no one exemplifies this better than Warren, one of the most successful investors of all time. He did not build his fortune by betting on fleeting trends or chasing quick profits. On the contrary, he understood early on that true financial growth happens when you allow time to work in your favor. He realized that the stock market can be volatile in the short term, but historically tends to grow in the long term. And that is precisely where the secret of great investors lies: waiting for the right moment without giving in to the pressure of immediacy. For many, the idea of waiting years or even decades to reap the rewards of an investment may seem discouraging. After all, we live in an era of instant gratification, where social media and technology have accustomed us to quick results. But patience in the financial market is a skill that separates successful investors from those who are always trying to recover losses. Imagine planting a tree. You don't expect it to grow and bear fruit the next day. You need to care for it, water it, and above all, wait. The same goes for investments. He likes to compare the financial market to a garden. It's necessary to know which seeds to plant, but above all, you must have the patience to let them grow. Throughout this video, we will explore how patience was essential for Warren to build his financial empire, and how you can also apply this principle to achieve solid and lasting results. We will uncover practical strategies, inspiring stories, and valuable tips to help you develop this winning mindset. Get ready to understand why, in the world of investments, waiting can be the most profitable decision you can make. If you've ever felt that anxiety to act quickly in the market or were tempted to sell an asset out of fear of losing money, this content was made especially for you. Let's discover together the transformative power of patience in the financial market. Let's begin. Buffett has always emphasized that success in investing is directly linked to patience. For him, investing is not a 100-meter sprint, but a marathon. This mindset translates into a simple philosophy: buy shares of solid companies and wait for time to do its work. But why is this strategy so powerful? He often says, "Time is the friend of wonderful businesses and the enemy of mediocre ones." This means that companies with solid fundamentals tend to grow and prosper over the years. Investors who understand this and hold their positions in these companies reap exponential rewards. A classic example of this mindset was his investment in Coca-Cola. In 1988, he bought shares of the company when many believed the soft drink market was already saturated. Instead of chasing quick profits, Warren held onto his shares for decades. The result? This investment yielded billions of dollars for Berkshire Hathaway, his holding company. He didn't buy expecting an immediate surge, but because he believed in the company's long-term potential. Another example was his investment in American Express in the 1960s. After a financial scandal, the company's stock plummeted. Many investors fled in fear of the consequences. He, on the other hand, analyzed the true value of the company and realized the crisis was temporary. He bought a large number of shares and simply waited. Over time, American Express recovered and became a financial giant, rewarding Buffett's patience. This approach is directly linked to the concept of value investing, created by Benjamin Graham, Warren's mentor. The strategy consists of buying assets below their intrinsic value and holding the position until the market recognizes that value. It's not a matter of luck, but of careful analysis and, most importantly, patience. He also emphasizes that investors must resist the temptation to act all the time. He compares the market to a baseball game where the investor can wait indefinitely for the perfect pitch before making a decision. Unlike other sports, in the stock market, there's no penalty for waiting. This metaphor highlights how patience is a strategic advantage. In contrast, impatient investors often fall victim to emotional behavior. They buy stocks when the market is rising, driven by euphoria, and sell during crises, guided by fear. This behavior leads to impulsive decisions and losses. Warren, on the other hand, acts calmly and sees moments of crisis as buying opportunities. The 2008 crisis perfectly illustrates this mindset. While many investors were panicking, Buffett made strategic investments in companies like Goldman Sachs and General Electric, taking advantage of depreciated prices. He didn't know exactly when the market would recover, but he trusted that well-managed companies would eventually thrive. Another crucial point in his philosophy is understanding that sustainable growth takes time. He states, "You can't produce a baby in 1 month by getting 9 women pregnant. Just as great businesses take years to mature, great returns also require time." Warren didn't become rich overnight. He built his fortune slowly, with patience and discipline. And that's exactly what he recommends. Invest with a long-term mindset and let time work its magic. His patience isn't about waiting passively, but about acting wisely and with discipline at the right moment. This behavior is reflected in 3 fundamental pillars of his investment philosophy: emotional discipline, thorough value analysis, and taking advantage of market crises. Let's dive deeper into these concepts. Warren understands that the greatest enemy of an investor is often not the market, but the investor themselves. Lack of patience and emotional behavior can lead to disastrous decisions. He often says, to invest successfully, you don't need a stratospheric IQ, unusual business insight, or insider information. What's required is a temperament that controls the impulses that cause other people to make investment mistakes. This emotional discipline allows him to avoid being swept away by panic during crises or by euphoria in prosperous times. He observes, analyzes, and waits. A clear example of this occurred during the tech bubble in the late 1990s. While many investors were betting fortunes on unprofitable startups, Buffett was criticized for staying out of this trend, but he stuck to his strategy. When the bubble burst, millions of investors lost money, while he remained steady, proving that patience and discipline are more valuable than following trends. Another aspect of his patience lies in his ability to deeply study companies before investing. He doesn't seek quick gains, but businesses with solid fundamentals, competent management, and lasting competitive advantages. Warren dedicates hours to analyzing financial reports, balance sheets, and business strategies. He only invests when he is fully confident in the company's real value. A remarkable example was his thorough analysis of Apple Inc. For years, he resisted investing in the company, believing the tech sector was too volatile. However, upon realizing that Apple had transformed into a consumer company with a loyal customer base and a robust ecosystem, he finally made a massive investment. This well-considered decision earned billions of dollars for Berkshire Hathaway. This example shows that patience is not inertia, but the necessary time to make informed decisions. He doesn't rush, but he also doesn't hesitate when the right opportunity arises. Warren is known for saying, "Be fearful when others are greedy, and be greedy when others are fearful." This principle is reflected in his ability to turn crises into opportunities. During the 2008 financial crisis, while the entire market was in panic, he saw clear opportunities. He invested billions of dollars in companies like Goldman Sachs, General Electric, and Bank of America, buying shares at extremely low prices. His patience allowed him to wait for the economic recovery, resulting in extraordinary profits. Another recent example was during the 2020 pandemic. Buffett surprised the market by selling stakes in airline companies, recognizing that the sector would face prolonged difficulties. This decision reflected his understanding that patience also involves knowing when not to invest or when to exit positions that no longer make sense. But he also used the crisis as an opportunity, reinforcing investments in resilient companies with growth potential. This shows that his patience is not passive. He analyzes the context and acts with firmness and conviction when he recognizes the right moment. Warren is also a strong advocate of compound interest. He began investing as a child and acknowledges that a significant part of his wealth came from simply starting early and letting compound interest work for him. He explains, "My wealth has a lot to do with living in America, with some lucky genes for business, and with compound interest." This statement highlights the power of time combined with patience. Consistent investments, even if small, multiply over the years. Buffett does not seek extraordinary profits all at once, but modest and steady gains that grow exponentially over time. One of the most counterintuitive investment ideas he advocates is that often the best decision is to do nothing. He states, "The difference between successful investors and those who fail is that the successful ones don't feel the need to always be doing something." In today's fast-paced world, where we are bombarded with information, it's tempting to act constantly. But Buffett teaches us that patience also involves the ability to wait for the perfect opportunity. He uses the analogy of a hunter who patiently waits for the right prey instead of wasting energy chasing every movement. This strategic calmness allows him to avoid mistakes and seize opportunities more effectively. Patience, therefore, is not just a virtue in his philosophy. It is a conscious and disciplined strategy. It enables investors to resist emotional impulses, conduct thorough analysis, and take advantage of the best opportunities when they arise. By adopting this mindset, you are not just investing money, but also investing in a mental approach that can transform your financial results. Throughout this video, we have seen how patience is a key element in Warren's investment philosophy. More than just a simple virtue, patience is a powerful strategy that allows investors to identify opportunities, avoid hasty decisions, and reap the rewards of time. Buffett teaches us that the financial market is not a game of speed, but of endurance. Those who can control their emotions, calmly analyze opportunities, and resist the pressure for immediate results are the ones who thrive in the long term. And the beauty of this approach is that anyone can apply it. You don't need to be a financial expert to understand that solid businesses take time to develop. Just as a tree needs years to bear fruit, a consistent investment grows over time. And it is precisely in this slow and steady growth that true wealth resides. Warren built a billion-dollar fortune not by luck, but by consistently and patiently applying these principles, and you can follow the same path. Remember, the difference between a successful investor and one who fails lies in how each handles time and emotions. So, how about starting today to cultivate this mindset? Analyze your financial choices and reflect. Are you acting with patience or being driven by haste? The future will reward those who know how to wait and act wisely. If you enjoyed these lessons and want to learn more about achieving financial success inspired by great investors, don't forget to like this video and subscribe to the channel. That way, you won't miss any content that can transform your perspective on finance and investments. See you in the next video.